Good afternoon, and it is indeed an afternoon, just gone noon, and here we are with an update on the 12B tax incentive opportunity offered by Jaltech. Jonty, I've done a lot of my own research on it, and I'll introduce you in just a moment, and also just unpack exactly what I found. But to let you know, those of you who haven't met Jonty Sachs from Jaltech, he's with us now. And just before I give you my little story, Jonty, let's find out from Stu exactly how the tech is going and make sure that everybody is connected. Stu?
Excellent. Thanks, Alec. Those new to the webinar, there's a little control panel at the bottom of your screen. There should be a little high five option. It says raise hand. If you can hear my voice and see me on screen, can you please give me some high fives? There you go, Alec. I love it when they come through. We also like to keep the webinars conversational. On that same control panel, there's a little Q&A option. If you can please put your questions in there for Alec, and John T will get through them as he can, when he can. But all good this side. Alec, thank you very much.
Magic. John T, from your side, there is an issue when it comes to participating in 12B, because if you put your money into the solar projects too late, then you can't have the full tax benefit. And I see that you're closing off this latest tranche, if you like. Maybe you can just explain to us before we start how that whole thing works.
Yeah. Hi, Alec. So Section 12J, Section 12B, which is unlike Section 12J, has a requirement on, in this instance, the fund manager to raise the capital, find the projects, do the credit, finance the projects, and then those projects have to be producing electricity before the end of February. If they aren't producing electricity, this means that the tax benefit will roll over into the following year, or as and when electricity is produced. So, for investors who invest this time of year, they've got the highest probability of being fully deployed, or all their capital being deployed. Where if you invest later in the year, then that at the time really starts becoming a bit tight. And, ultimately what happens is investors won't get the full benefit. Now, this is the last year, and I'll touch on it in my slides. This is the last year where an investor will be entitled to get 125% tax deduction. So, I tell people that this is probably the best tax incentive that will ever be in this country. 125% of your investment value is tax deductible. It's incredible. Now, if you invest later in the year and you don't get all your capital deployed, you'll only get next year at 100%. So it's for investors, this is the best time to invest because your risk of deployment is at its lowest.
Okay, thanks for unpacking that. My friend Rory Steyn, who used to be Madiba's bodyguard, and we've got to know each other pretty well over recent years. He dropped me a mail and said, "Are you going to invest here?" And I said, "Wait, Rory, let me just go and do my research." And I did all my research, and I would love to, but I have a very hungry, voracious appetite called BizNews, which unfortunately needs to suck in all of my additional capital. So I'm not in a place right now where I can participate. I really wanted to, but if I wasn't in that position, in other words, if I wasn't running my own business, and if it wasn't at a capital hungry stage, which it is right now, we've got so many great growth opportunities, I would certainly have been putting my money in. So I guess in a way, it's an endorsement. What I'm saying is I would have been with you, and I said to Rory, go for it, because I would have, but from a personal point of view, just to clarify where we are, I haven't made the investment. Stu, what about you? I know you've also been having a look. Are you going to be popping some money into the Jaltech fund?
Alec, I did Jaltech a few years ago, and I'm still I'm still busy playing there to sort out the finance stuff. So unfortunately, I'm not in a position to play this yet.
Okay, so you can see we are very supportive of what you're doing, Jonty, and we think that our community and our tribe will be well served by what you've put together. But just from a personal point of view, and actually it's probably what you've just said now, the last opportunity to take advantage of something that, again, I spoke this morning with the chairman of Eskom, Mteto Nyati, and it was interesting to get his projections into the future with the amount of solar energy that's coming in through the private sector initiatives, through exactly this tax incentive. And it looks like they're not going to repeat it when this ends. So it is, as you've just said now, that this is kind of the last opportunity to participate in a wonderful tax benefit, which was available because of a particular set of circumstances in the country. But it now appears, certainly from what the Eskom chair was saying, that they've now got their, on the one hand, they're getting their maintenance in order at Eskom. They've brought in some incentives to get the power stations and the management of the power stations more efficient. But on the other hand, there's been such a take-up on the solar opportunity, both through the tax incentives and through the RPPs, that it's like South Africa's over the hump of load shedding, and they're going to have a lot of excess power into the future, which is good news for the country, but it's also a big warning that this 12B is not something that's going to be with us forever. So I'm glad you made that point straight up, Jonty. Perhaps we should go into your slide presentation and then we can take questions.
Alec, thank you very much. And, thanks for the vote of confidence. I think similar to how you reinvesting into your business, myself, my shareholders, my partners, we also reinvest into our funds. So, I invested last year, so to my partners, and I'll be investing this year again. So we always put our own funds into these investments because we need to align ourselves with our investors as much as we can. So let me share my screen and let me take everyone through the investment opportunity. And I think, the common disclaimers that come with these type of presentations is, this is high level information. I am available. There are members of my team who will gladly assist and go into the investment in much more detail with investors. So take in the information, and if there's any questions, put them in the Q&A and I'll answer them. And what Stu's gladly offered is, if you are interested in the investment, there'll be a poll, indicate so, and then we'll reach out to you and we'll schedule either one-on-one or give you the information you need. So I think the big allure from this investment is that with a large tax deduction, coupled with a conservative amount of gearing, investors can get up to 90% of their money back in the first year. And this is largely to the tax benefit and some cash flows. And it all depends on your tax rate. And I have a table which will show you. So if you're in the highest tax rate, then most likely you'll get the full 90% back in year one. And if you're in a low tax rate, this will decrease. So a little bit on Jaltech, for those of you who don't know us, we're alternative investment fund managers. We manage over 2 billion Rand. We've got over 1,700 investors. And we, very honored to be supported by a large amount of the business community. In the solar sector, we've got really exceptional track record. In the last year, we financed over 27 megawatts of solar installations. We deployed over 365 million Rand, and we financed over 159 solar projects. We're looking to significantly more than double this in this financial year. And I'll take you through how we're going to achieve that. And, our track record stems across industries, whether it be student accommodation, property funds, commercial, industrial. We've really seen a lot of projects, and we work with a lot of the market's top solar installers, developers. So into Section 12B, it's been around since 2016 and really only gained popularity last year. And this is really around the introduction or the enhancement of the tax incentive to be at 125%. Now, there's a requirement to get this tax deduction. So the one requirement is that the capital is used to acquire solar panels, batteries, and inverters. And then, as I mentioned earlier, that the combination or the system needs to produce electricity within this financial year. And if it doesn't, you don't get the full tax benefit in this financial year. You'll get for whatever has been invested, and the remainder will then roll over into the next financial year. So hence why investing now is a good thing. And, as I mentioned, this is the final year at 125%. Now, just to explain what the tax deduction looks like, here's an example of an investor who doesn't invest. So they've got really nice taxable income. It's 5 million rand, and their taxable income could be from a property that they've sold, or a share portfolio that they've sold, or income or bonus that they've received. But their taxable income now is 5 million rand, and they don't invest. They're going to pay around 2 million rand in tax in this financial year. So this same person decides they're going to invest R1 million. This investment is 125% tax deductible. So although they only invested 1 million, they can reduce their taxable income. They can reduce the 5 million rand on which they would have paid tax by 1.250 million. Okay, so now when they calculate their taxable income, they're not going to calculate it on 5 million, they're going to calculate it on 3.7. They will then only be paying roughly 1.5 million rand in tax. That is a tax saving of 562,000 rand. In other words, for 1 million rand invested, 56% of the investment they're getting back as a refund from SARS. So if you're a provisional taxpayer, if in August this year you're going to pay a provisional tax, if you invest with us, you'll be able to reduce your taxable income in August. You will pay less tax in August. If you are a PAYE payer, in other words, your company withholds your tax every single month, you'll invest with us in March, in 2025, you'll then submit your e-filing, and around July, you'll then receive a refund from SARS. You'll actually receive a refund for Section 12J investors. That's what they experience. They receive the refund. And I can tell you 99.9% of, 1,000 plus investors we have in 12J, they almost all got their tax deductions. Those that didn't, or should I say those that struggled to, I'm not aware of anyone who didn't. Those that struggled to, it was because their tax affairs weren't in order. It had nothing to do with the tax deductibility of the investment. And the same would be true with Section 12B. So, one of the major risks I mentioned is deployment. We've known that this risk was from the start. So we have spent the whole of last year and this year in developing a pipeline, because the more opportunities that you have to fund, the bigger your pipeline and the greater the probabilities of deploying. And that really worked in our favor last year. And this year, it's we're really now reaping the benefits. We've signed term sheets with more than 15 significant players in the solar market, and the cumulative term sheet value is over R1 billion. Now, this really means that these participants will give us all their business. So we've got exclusivity up to a certain value, and that value is around R1 billion. There's no guarantees that they'll have R1 billion worth of business, but we're not beholden only on these 15. There are many solar installers, as an example, that give us business at the moment, more than 50. These 50 give us quotations, and we quote to their clients on a daily basis at the moment. And this year alone, we've quoted on more than 2.6 billion rand in solar deals. And week on week, for the last 10 weeks, we've quoted on more than 100 million rand. Now, this is very early on in the deal cycle, and the clients get the quotes. They then take time to review them. But the picture that I'm painting is that at the moment, we've got quotations of 2.6 billion rand in the market. Maybe over the next 2 months or 3 months, we close 10% of that. That's 260 million rand, and maybe a month after that, another 5%. But ultimately, what I'm trying to demonstrate is that we've got such enormous deal flow and volume that we are really confident that for our investors who invest now, the likelihood of being fully deployed is extremely likely. We are raising a tranche. The tranche is around 250 million rand. There's about 40 million rand of that tranche remaining. And we're looking to close the fund in the next, we were aiming to close it at the end of the month. We're going to extend it a bit for the business community. And then once that tranche is closed, we then commit the capital, and only then will we raise the next tranche. And that's what we did last year. It was very, very effective for our investors. Our investors who came in June, we told them the probability is highly likely that they will be fully deployed or fully committed, and that really was the case. So this is really the time to be committing to this type of investment. We can achieve these levels of deployment because we've really invested in our team. Now, at Jaltech, we're around 24 people. In the solar team, we're 13, and we're growing. We are interviewing people at the moment. And the team is made up largely of transactors, fund managers, who process the deals, they negotiate the deals. We've got 3 full-time lawyers, and that has been really a huge fundamental move for us. To outsource the amount of legals that we have just took too long. So having an in-house team has really been effective. And then there's the business development team, which I head up, and we help with fundraising, but also with finding partners to finance deals. And in total, in the last financial year, we invested on average 93% of our investors' capital. The shortfall was really explained to our investors that came in late, that we may not have time to fully deploy, but by and large, almost all the capital was deployed, and it has now been deployed into projects. So that's really the background, and now into the investment. If you invest with us, really you're getting exposure to an opportunity to reap the benefits of returns in the solar sector. And what we do is we find commercial and industrial energy consumers, so large businesses, whether it be farms or hotels or manufacturers that consume a lot of electricity, and we enter into power purchasing agreements where we finance the solar and we sell electricity to them on various type of terms. But ultimately, we're selling electricity to them at a rate that's cheaper than Eskom. If they default with us, they're going to then have to pay Eskom a higher rate and potentially unreliable source of electricity. But if they do a deal with us, they're going to be buying electricity mostly at a much cheaper rate. So they're incentivized, and we're incentivized because that rate generates a really nice return for our investors. And how we do this is a solar installer will come to us. They have a customer that's accepted a quotation. We'll do a credit review of the customer. If we like them, we'll purchase the assets. We'll fully finance the assets. The solar installer will do the installation and the operation and maintenance for the next 10 or 12 or 15 years, however long the term of the power purchasing agreement is. And our terms are very, very competitive. If the same customer went to a bank, the bank would ask for a 70%, would only give a 70% debt, where the customer would have to put on 30%. We would finance 100% of the asset. Banks can only finance over 5 to 7 years. We can finance from 10 to 20 years. And that's really the significant competitive edge that we have. If you finance a 10 million Rand solar installation over 15 years, the annual cash flows paid to us by the consumer is, in most cases, less than what the system produces. So the system may produce 1 million Rands worth of electricity a year, but our cash flow requirement is 750,000. So there's a saving to the energy customer of 250,000 in cash flow for that year. And that has been a huge reason why we're able to source such a large volume of deals, because our funding rate or our power purchasing agreement tariff is really, really competitive. And we don't take long. Banks, it's a long process. For a new customer to deal with a bank takes long. For us, 2 to 3 weeks. And our solar installers who work with us, they love this because the longer you wait on a client, the longer it takes to close a deal, and we can finance pretty rapidly. But the real, as I mentioned, the real allure here is this huge tax benefit. And I'm going to, over the next couple of slides, I'll explain how it works. So, as I mentioned earlier, if you invest 1 million Rand with us, if you're in the highest tax bracket, you'll receive a tax saving of 562,000 Rand. And that's from SARS, that's got nothing to do with Jaltech, that's the tax benefit. But what we will do in the same financial year is raise some debt into the investment on a ratio of 2 to 1. So for every 2 Rand of equity, we're only raising 1 Rand of debt. The more debt you raise, the riskier this investment becomes, and we don't want to overexpose our investors, but we want to try and de-risk them as quick as possible, but keeping in mind the level of risk. So an equity to debt ratio of 2 to 1. By raising, in this example, 500,000 Rand of debt, it allows the structure, which is a partnership, to buy an additional 500,000 Rands worth of solar. So because our investors are partners in the partnership, they indirectly, through the partnership, have 500,000 Rands worth of additional solar. So they can claim another tax deduction, in this case of 500,000 Rand, or 125% on 500,000 Rand. and that'll give them a tax saving of 289,000 Rand. Now, if you add these two savings together, plus a small amount of cash flows in the first year, this investor in the highest tax bracket is receiving approximately 90% of their money back in the first year. They're getting a return on the million Rand, but they're getting 900,000 Rand back, and they're de-risked by 90%. So now what happens? So we then go and we finance all these solar opportunities, and then our investors start generating a return. And the returns, which I'm going to explain in a moment, these are not these are conservative projections based on transactions that we've already done. So we're not new to this. We're not hoping that we're going to sign incredible deals generating insane returns. These are typically the most competitive, based on competitive terms that we can place into the market. These are the type of returns that we can generate for our investors. And what you will see, so the first line is the refund. The second line is the income generated. Now, what is hard not to miss is in the first year, it's 43,000 Rand. And then it increases to 50,000, and then it goes to 85,000 in year 6, and to 116,000 in year 9. And what you are noticing is that it increases, or it escalates over time. And that's by design, because when we sit down with the energy consumer, we need to be competitive with Eskom. And how we achieve this is we have a low rate in year 1, and that rate increases over time. And it increases at a fixed rate, around 6%, but this rate is generally lower than Eskom. So Eskom on the 1st of April increased by over 12%. The next year and the next 2 years, they've clearly forecasted what their rate's going to be. And we are our rate's much lower. So we are able to secure these rates, and our investors start to generate really nice returns over time as these rates escalate. Now, if you look at it on an average annual basis, what is the income being generated? Well, it's approximately the yield is approximately 9% in the hands of the investor. Okay, but that excludes the final year payment. So what you'll see in year 10 is there's a huge lump sum of 1.3 million Rand, and there's an assumption here. And the assumption here is that what we are seeing is we at the moment signing 16-year power purchasing agreements. We only want investors invested for 10 years. The future cash flows, so at year 10, we then forecast that we're going to sell the future cash flows. These are contractual cash flows with counterparties that are creditworthy, and the future income is really predictable. So we can sell these cash flows to most of the banks, buy them. They buy long-term asset rental books, which really this is what we're selling, and it generates a large amount of income for investors. If we can't sell it, it's not the end of the world. At year 10, we would have paid off our the debt to the banks, and the annual payments would then increase to over 200,000 Rand. So worst case scenario, we don't sell the assets, and our investors get a nice 200,000 Rand plus for the remaining term. The returns from this investment, as you can see at the bottom of the slide, they're very high. And they're high not because we are doing magic at Jaltech. We're not the best fund manager in the market. There's a huge tax benefit here. And coupled with really nice returns, which escalate over time, generates these really huge IRRs. And the IRRs are high because a lot of the return is upfronted. The tax benefit of 90% in year 1 with the cash flows really pushes the IRR to a high number. But it depends on your tax rate. So if you're at 45%, I've just demonstrated what the returns are. Let's use an example at 36%. So if you're at the 36% tax bracket, your pre-tax IRR is 28%. At year 2, you de-risked 77%. If you're at 26%, your pre-tax IRR is 20%, and you de-risk in year 2 just under 60%. So it really depends on the tax bracket that you're in. But I think these returns, in the mid-30s are really acceptable. But as you get high up in the tax bracket, it becomes really significant, these returns. We haven't factored into additional potential incomes into this investment. One is wheeling, so any excess electricity we can sell into the grid. We haven't gotten there yet, but where we are imminently about to conclude a deal is on carbon credits. Our investors own the assets, they own the carbon credits, and we're hoping to generate an additional 70 bips or 0.7% annual return to our investors through the sale of carbon credits. This investment isn't without risks. There are a number of risks, but these are the 4 important ones. Deployment risk, which I've mentioned in great length, and major risk is credit risk. So we need to find creditworthy counterparties that are going to buy electricity, that aren't going to default. And what I mentioned earlier is we're seeing such deal flow volumes that we're really looking to secure the cream of the market. And by having such deal flow, we are able to credit vet a lot of businesses and ideally only do businesses with businesses that are really creditworthy. And we've achieved that to date, and we haven't had any defaults so far. When you introduce debt into an investment, your risk does increase. Our debt to equity ratio is very low, but very importantly, our debt funder only has recourse against the assets, the solar assets. So if this investment, which is very diversified, I suspect between 10 and 20 different solar projects, maybe more. If whatever happens, they all go to zero, the debt provider will not go after our investors in their individual capacity. The debt provider will take the assets, sell the assets, and get their money back. And that brings me to an obscure risk, and that's Section 12B risk. And what this risk is in order for an investor to get 125% tax deduction, they need to be at risk for their investment amount plus 25%. If they're not at risk for this additional 25%, they aren't entitled to 125% tax deduction. So what this means is if this investment goes to zero, or there's a huge liability that exceeds our assets, investors may have to put in an additional 25%. We obviously, as a fund manager, we would suffer real reputational harm if this would happen. So we've got a number of risk mitigants in place to prevent this. For example, major liability that we could incur is if a solar asset burns down a property. And we've got adequate insurance over the assets, and we require the property owner to insure the property. So we've gone with this risk mitigant and others. We've really tried to put our investors in a position where they would almost never be in that position. But I need to disclose that that is a requirement from Section 12B. The next slides I'm going to rush through. If you are a Section 12J investor, what's happening in your life at the moment, if you're exiting Section 12J, if you invested $1 million, you're going to get your R1 million back, hopefully. For some, that isn't the case, unfortunately. 40% of the million needs to be added to your taxable income because you pay capital gains tax on the full $1 million. So your taxable income will be 400,000 Rand, and at 45%, 180,000 Rand is being paid to SARS. Before paying the sum to SARS, if you invested with us, so here's the example: you invest, your taxable income is 400,000. If you invested 214,000, so instead of paying 180,000 to SARS, you invest 214,000 with us. We add some gearing, which will bring you to 320,000. At 125%, that's going to give you a tax deduction of 400,000. So by investing 214, you're getting a tax deduction of 400,000, and you won't have to pay the tax on exiting your Section 12J. So this has been taken up by a lot of investors who are exiting Section 12J funds at the moment. They're all receiving their money from April to June, and this is a really neat solution, but I can imagine a number of you are still in your Section 12J investments, so this might not apply to you. Investment highlights: minimum investment is 500,000 Rand. Aiming to get 90% of your money back in the first year. Investments supported by assets. You exited every year through distributions. I mentioned the IRR, it's really high. The tax deductibility with gearing is 187%. We've got a fundraising cap, and you invest it for 10 years where you'll receive distributions. And then I just have 2 more slides. Our fees are 2.25% per year. And then we charge a performance fee, which I'm going to explain in the next slide, of 20% above a hurdle. And if we don't hit our hurdle, we don't get a performance fee. And in the following year, we need to catch up before we earn a performance fee. But this is a very important slide. And I really think that investors need to be mindful of this, is that there are 2 ways of charging performance fees. There's the gross capital performance fee and a risk capital performance fee. We charge the gross capital performance fee. If you invest 100,000, if we generate you 120,000 Rand in income, the difference is 20,000 Rand. And we charge a performance fee on the 20,000 Rand, which is 4,000 Rand in this example. So as a percentage of your profits, we only charge 20%. Where another way of charging performance fees is called risk capital performance fees, which we don't support. That's where if you invest 100,000, you're getting 56% back. So 100,000 minus 56% is 44,000. So there are fund managers that charge a performance fee above the 44,000 Rand. Now, assuming the returns are the same as ours, you're receiving 120,000, you're going to be the performance value, which the fund manager now has determined, is 76,000 Rand. So they're taking the SARS tax benefit into account in calculating their performance fee. So 20% on 76,000 is 15,000 Rand. So of the total profits, they are taking 75%. This investor will get 105,000 Rand back, and the fund manager will get 15,000 Rand, making more than the investor makes. This is not a performance fee which we apply, but I'm not going to go into much more detail than that. But I think investors need to understand how performance fees are calculated. Stu, if you wouldn't mind running the poll, if you are interested in the investment, if you've got loads of questions or want information, you can indicate in the poll that whether you'd like to meet with us. And if it is the case, then I'll reach out to you and we'll set up a meeting. And then obviously the disclaimer I gave early on is if, don't rely on all this information, reach out to us, speak to a financial advisor, and make an informed decision when investing.
Well put, Janti. Thank you. It certainly is pretty clear for me. I know we've done a couple of these webinars already, but it still is nice to have it recapped. We've got a couple of questions, and just to remind you that when you type in your question, your full name will come up, but I will only use your first name. So that helps to retain anonymity. William has got two questions for you, Janti. Number one, is all else the same and the returns proportionate to the investment? Rather than R1 million, if the investment's R500,000 Rand, are the returns 50% of the example numbers based on R1 million? In other words, the numbers you've shown us are for R1 million. If you put in R500,000, are the returns half that?
Yeah, so to answer your question, is the cash flows that I showed assumed an investor invested R1 million. So if you're going to invest 500,000, you can halve those numbers, and that's what the returns will be. And at what point it makes sense, it really depends on the investor. So one of the slides, and the recording of this will be made available, one of the slides showed you the returns based on the different tax brackets. So have a look at that slide, determine which tax bracket you're in, and then see whether that type of return interests you.
And his follow-up question actually goes to the second point. At what tax level, if any, doesn't this investment make sense?
It all depends. So personally, I wouldn't invest if I was at the 18. For me personally, at the 31% tax bracket, it makes sense. But that's my personal view. And some people, would be interested at the 26%. It's a real personal thing. So it's hard for me to give that type of advice.
I know you're a lawyer, not an accountant, but what is 31% tax bracket? How much is that?
I don't have those numbers off the top of my head.
I'm sure Stu can just Google it for us. So he'll have it for us in a moment. Ron says, can juristic bodies or inter vivos, i.e. inter vivos trusts, can they invest?
Yeah, so any taxpayer, individuals, companies, and trusts. And to get a little bit technical on the company side, if a company invests, they're getting a tax benefit on 27% times 125%, which is around 32%, versus an individual that gets 56%. So, what you could do as an individual who owns their own business is maybe pay yourself a large bonus, which attracts 45% tax, and then invest the bonus, versus investing in the company's name. But for many people, that isn't an option. They need to invest in their company, which is great. We've got a number of company investors, but there are ways of structuring your tax affairs to maximize the tax benefit.
So just to repeat that, a company can invest, as well as individuals.
Companies, individuals, and trusts can invest.
So the government really wanted to spread the net. Do you have any idea on how much has been put into the 12B, into this 12B option? Because we certainly are seeing an impact on the electricity supply side.
And if I had to guess, I would say it's around the R1 billion mark at the moment. But that's that would be a guess. Yeah.
Ryan has got a question. He says, are controls in place to potentially manage payments for electricity used from defaulting customers?
Yeah, so depending on who the customer is, if a type of opportunity which excites us is malls. Large malls, especially as long as they're in really good locations and occupancy isn't an issue. Malls are great because you have prepaid meters, and unless you're paying for your consumption upfront, then you don't. Then you're not going to get electricity. So that's a great way that we do it. But if you're thinking like that, then you're dealing with a counterparty that isn't creditworthy. We look at businesses where the electricity bill is not a thing in their life. That's not a big focus of ours. What we look at is, have they paid Eskom? What is their consumption? That along with general business cash flows, profitability.
A follow-up question from Ryan. For the leveraged portion of the investment, should interest rates escalate, would the investor be liable to make up the shortfall between income and cost of capital?
No. The investors are completely separate from the debt, other than benefiting from it. They have no responsibility at all to the banks. In almost, I want to say in every instance, I can't guarantee that, but I think in almost every deal we've done, it's linked to the interest rates. So if the interest rates do go up, then the price that we sell electricity will go up, and that'll cover the additional cost of the debt. But that also goes if it goes down. And if interest rates go down by 1%, the example I gave earlier where our net IRR was 21%, that'll go to 19%. So not a massive impact from the interest rate, but yeah.
Jaco's question, what is the minimum investment period? And the second one, a follow-up there, is what is the consequence in withdrawing before this period is reached?
So the minimum amount is 500,000 Rand, and it's a 10-year investment. Now, we don't really have an option for investors to exit early. You're welcome to sell your investment to a third party. It'll be difficult to do. What I say to investors is you are getting, if you're in the highest bracket, 90% back in year one. So you are largely exited. But if there's a huge cash crunch or there's a dilemma, investors can approach us, and we'll try to come up with a solution. If there's liquidity, we may assist them. There's no guarantees. We are human beings after all, and we will try and help people if the need arises. But the mindset needs to be, I'm invested for 10 years.
Stu, thanks for putting that tax table up, and now it's pretty clear. So at the 31% marginal level, you're talking about, call it 60,000 Rand a month, 512,000 per annum, 12,560 up to 70. Yeah, it's about, I guess you could call it below 60,000 Rand a month in your earnings. It wouldn't make sense. Above that, you talk about 31%, Jonty. It would. Is that about right?
Yeah, that's about right. Obviously, as you invest more, it's going to reduce your taxable income. But if you end up being around the 31%, then yeah, absolutely right.
So it's not certainly, as far as the Business Tribe are concerned, it's not out of reach for a great percentage of our members. Just from my side, there were a couple of questions I had on the presentation. You say that this tranche is 250 million Rand, and there's 40 million Rand left of it. How do you just take us through that kind of calculation, how that works out?
Yeah, so we launched this investment, I think, around March, and over the last couple of months, we've got a lot of investors who've indicated that they're interested. Part of it is investors, and a large part of it is financial advisors that give us business. So at the moment, we've allocated 210 million Rand to our investors and financial advisors. some of the financial advisors might not take up their full allocation. There'll be more capacity, but you know, obviously the business community will be looked after. So, you know, we were looking to close the investment at the end of the month, which is next week. Because of the date of this webinar, happy to take money probably until, you know, the first or second week in June.
All right. But that 40 million, once that's done, then you'd have to wait for another tranche. And the other tranche, as we mentioned right in the beginning, might not give you the full 125% deduction, because it's going to be pretty hard now, getting closer to February, to find a place to put the money.
Yeah, so we raised a second tranche last year in September, and I think we invested 91% of it. So it's still incredible. You know, you're still getting, you know, 125% on 90% of what you've given us. But, you know, we'll fully disclose to investors when we launch our next tranche, you know, where we stand. What we're hoping as a business is in the next 6 weeks to commit all the capital. So to sign deals where we know our allocation that we've raised is now committed to projects, and then we can go to the market and say, listen, we're now starting to raise. But what we do, Alec, is we don't take all the money. So if someone, you know, invests $1 million, we ask for a 10% first drawdown. We then, middle of June, we're going to ask for a 40% drawdown. Once that's committed, we then do our next drawdown. So not all the money is needed today. It'll be needed over time, probably by, you know, August.
But at least, you know, with this tranche, you are going to get your 125% deduction from SARS.
There's certainly no guarantees. The probability is extremely high. You know, a project might, I don't know, implode. Who knows? At the very end, which is, you know, unlikely but possible. So I can't guarantee anyone they're going to get their full tax deduction. It's highly likely at the moment.
How strict are you on the deal flow? You said there's a lot of deal flow coming through. Just as a gut feel, for every 10 deals that are offered to you, how many would you take?
It's around, at the moment, what we're seeing is around 5 to 7% of deals that we price, we approve. So it's low, and that's what you want. You want huge volumes and low approval rate, because, you know, like, it's easy taking people's money and it's easy trying to find deals. What the problem is, in 3 years' time, if we do poor deals, to sit with investors and say, you know, I'm so sorry, this person didn't pay, you know, that's the real pain of being a fund manager, you know, and we want to avoid that completely. We've avoided that with 12J. All our investors are gonna make money. No one's gonna lose money. Our performance fee isn't gonna erode their profits, and that's what we want in this space as well. So I would much rather not deploy everyone's money and have good investments than in deploy everyone's money and then have to, you know, apologize every year for poor returns.
That's quite an important stat, though. So it's almost like 1 in 20 of the deals that you look at that you do finally invest in, which I guess is quite a lot of comfort if I'm on the other end, on the investing end.
Yeah, it's, you know, it's difficult because ultimately you need to be really comfortable that these businesses are going to be around, you know, and that they're going to honor their obligations, and they've got the experience and the team, and, you know, it's a really grueling process, you know. And my partner Derek Hyde, one of the co-founders of the business, exceptional at what he does, but he's got the hardest job in the business. You know, it's high stress, lots of deals, a lot of issues to solve. And it's you know, it's a role in the business which I don't envy, but, you know, I'm honored and really grateful that we have someone of his caliber running this division in the business. So it's tough. It's really hard.
We had a great conference in London where we had Andrew Middleton, the co-founder and CEO of Go Solar, with us, and some of his investors. They're very impressive backing that he's got. I guess he would not be open to investments from Jaltech. He seems to have it all sussed himself. But is that the kind of organization that you do business with?
So Andrew's business, which is really, really impressive, they on the residential side. So that's not really a big focus of ours. Our focus is more commercial and industrial. And we would look at residential, but not at the individual homeowner. So we would be thrilled to provide Go Solar with a funding solution. Would be thrilled, but we would take risk on Go Solar. and we wouldn't take risk on the individual homeowners.
Well, that's good. That kind of identifies it. Well, we did promise that we would have a quick update today. William's got a question. Maybe we can finish off with this one. Are the annual cash flows you indicated net of management and performance fees?
They are, but they're not net of tax. So the numbers are after our fees, pre-tax, and depending on your tax bracket, you then calculate what the net number is. At the bottom of the page, we had the net tax, net of fees, net of tax number with the tax benefit, and that assumes that investors in the highest tax bracket. So if you're in the lower tax bracket, it'll be better, the returns.
William says, thank you, gents. I can echo that as well. Stu, anything last from your perspective before we let Jonty go?
No, all good from our side, Alec. The team will get the video up onto the YouTube channel as soon as they can for those who like to really look at what's been said and done here today. But otherwise, everything's done well. Tech was great. Thanks, Johns, for the presentation. And yeah.
Pleasure.
I think we need to sit with you, Jonty, and get some tips on how to run a Zoom presentation efficiently. Stu and I often hit little bumps in the road when we do our monthly webinar, but it has been a pleasure, as always, to be with you today. And from me, Alec Hogg, and Jonty Sachs from Jaltech, and of course, Stuart Lohman, my colleague. Till the next time, cheerio.